Here is the paradox. The quickest way to catch a turn is to stop chasing it. Gann taught that time, not price, draws the curve of reversal. Price is only the ink. When crowds lunge at new highs or flee collapsing lows, the market is merely finishing a prior sentence. The turn begins in silence in the calendar, in cycles returning to their anniversaries, in the fading vibration that precedes motion. You feel it as boredom, then doubt, then the impulse to overtrade. That is the trap. The law of vibration states that all markets move in harmonic relation. When time completes, price obeys. Professionals wait for time to mature. Amateurs force price to confess. If you prefer rule-based calm over reaction, stay with me. We anchor to a simple authority. Time dominates price. A swing chart records direction, but the master clock governs reversal. Watch the windows: 30, 60, 90 days, quarter and half-year anniversaries, the season when prior extremes occurred. At these dates, observe for secondary tests, low-volume retests after a panic, or thin rallies after a climax. The enemy is impatience. It wants prediction without confirmation. Gann insisted on confluence, a time window, a prior level crossed, and an overbalance of correction. When the current pullback exceeds the size or duration of recent reactions, the power structure is changing. Accumulation versus distribution reveals itself in that asymmetry. Operationally, decide in advance, define the time window, mark the old levels, and wait for the market to test and hold them on reduced volume. Demand a rule-based confirmation, a higher swing high after a secondary test, or a break of the last downtrend angle into the time window. Risk remains mechanical below the test for longs, above it for shorts. Mastery feels orderly, not exciting. The boredom becomes signal. If the secret is to wait, what exactly are we waiting for? We have time and a first test, but one confirmation still remains. Paradoxically, the market's future becomes visible the moment we stop predicting and start keeping time. Gann treated price as a passenger and time as the master clock, the definite regulator that brings order to what looks random. When traders try to outguess direction, they chase motion. When they measure cycles, they meet the schedule. Begin with an anchor, the last major low or high that produced an overbalance in price or time. From that pivot, lay your calendar. Note the 30, 45, 60, 90, 120, 180, 270, and 360-day anniversaries. Record 7, 9, 13, 20, 26, and 52-week counts. Square the range by projecting equal units of time against the units of price. Draw the 1x1, 2x1, and 1x2 angles to define the harmonic path. You are building windows, not forecasts. The enemy is impatience, the urge to trade between windows to confuse movement with meaning. Volume can swell and deceive. Patterns can bait and switch. The law is confluence. Time window plus structure plus a secondary test. Without all three, stand aside. Operationally, convert rhythm into rules. Maintain a swing chart so the trend is definite. Inside a projected window, require a retest that holds above an old low in an uptrend or below an old high in a downtrend. Demand confirmation by the crossing of the prior swing level. Prefer contractions of range into the test and an expansion on the break. Risk small and mechanical. Stops beyond the last swing. Position sizing set before entry. Psychologically, mastery feels like boredom disciplined into ritual. You observe, confirm, and align. When the clock and the structure agree, you act once, then you wait. If time governs price, the next question is simple. What evidence, precisely, declares the turn? That is where we go next. Now we dissect the confirmation itself. The fastest way to catch a turn is to stop trying to be first. Gann warned that markets reverse not because price decides, but because time completes its work. This flips the crowd's creed of price tells all. In his notebooks, the calendar is the quiet cause and price the visible effect. If you've ever felt the market outrun your discipline, stay with me. Within the first minute we establish the tension. Invisible turns occur when the clock, not the chart, reaches a vibration. Traders chase breakouts. Professionals wait for time windows. Authority rests on a simple doctrine. When time equals or exceeds the prior swing, the market is vulnerable to change. The enemy is impatience, masquerading as urgency. FOMO dressed as insight. The remedy is measured observation. We will mark cycles, wait for confluence, and require confirmation. This is not guessing, it is rule-based waiting. Begin by choosing a recent decisive pivot, build a clean swing chart, and count bars forward. 30, 45, 60, 90. Note the anniversary of prior highs and lows. Watch for an overbalance of time, a correction lasting longer than any prior correction in the trend. Demand a secondary test inside the window narrowing range, quieter volume, failure to cross old levels with authority. If the market is distributing, rallies will be labored. If it is accumulating, declines will grow orderly and measured. Mastery feels like boredom because you will pass on most signals. Your edge is patience plus the calendar. When the window opens, you will not predict, you will confirm. And yet one question remains. If the secret is to wait on time, what specific law governs these windows, and how do we make it definite rather than mystical? Time is the master clock. Price is the needle that follows. Gann's core law is harmony. When time, price, and pattern align, change becomes probable. We remove mystique by making time countable, not mystical. Anchor your study to a clear swing high or low. Build a 2 or 3 bar swing chart to eliminate noise. Count forward in measured intervals. Common vibrations include 30, 45, 60, 90, 120, 144 days or sessions, and their weekly or monthly equivalents. Layer seasonal cycles, quarter turns, semi-annual shifts, and annual anniversaries of prior extremes. The principle is binary, harmony versus disharmony. In harmony, trend impulses travel faster and corrections consume less time. In disharmony, corrections overbalance in time or price, warning of exhaustion. The enemy is randomness, the belief that every bar is equal. The model is mechanical, a master clock with nested gears. Minor cycles tick within major cycles. Confluence tightens probability. Operational rules are definite. Rule 1. Do not anticipate. Enter only inside a pre-identified time window. Rule 2. Require overbalance. If the latest correction exceeds the time of any prior correction in the trend, treat the trend as vulnerable. Rule 3. Use angles and levels as structure. A market deteriorating below its 1x1 rhythm or failing to regain a broken 1x2 warns of disharmony. Rule 4. Confirmation beats prediction. Look for a secondary test inside the window, a retest on reduced volume, narrowing range, and failure to cross old levels in the prior trend's direction. Psychological resolution is calm. Decisions feel measured, not urgent. You are either on time or you are out. As the framework settles, a practical dilemma surfaces. In real time, the crowd acts first and asks later. How exactly do we diagnose their motion from accumulation to distribution before committing? Most traders do not lose to bad analysis. They lose to good impulses executed at the wrong time. The crowd confuses movement with meaning. They buy strength at the end of a cycle and sell weakness when the clock is almost done. Their enemy is boredom, which they relieve by trading. Professionals relieve boredom by counting. In distribution, rallies are loud and short. In accumulation, declines are sharp then quiet. Volume can deceive in the middle. The truth often appears on the secondary test. Here is the crowd pattern. A strong thrust into your time window invites participation. Emotion reads inertia as inevitability. The professional response is opposite. Wait for the market to prove it can no longer cross old levels with authority in the prior trend's direction. If the trend was up, watch for an overbalance of time in the pullback and a rally that fails to reclaim broken structure. If down, expect a retest that cannot break the prior low with expanding effort. Checklist the deception. Narrowing daily ranges as price approaches an old high or low. Reduced volume on retests after a wide bar climax. Failure to carry beyond prior swing highs. Lows despite news or intraday spikes. A swing chart that has shifted character. More time spent consolidating than advancing. The moral law is clear. Confirmation beats prediction. Your role is observer first, actor second. You enter not because you feel, but because the market fails a test in your window. Mastery becomes the absence of urgency. Entries feel almost inevitable because the conditions are definite. Yet precision still demands a final filter. We have watched the crowd, counted the days, and marked the levels, but one test remains. How do we define the confirmation bar itself so that hesitation ends and execution becomes mechanical? Now we turn the philosophy into instruments. Application begins where prediction ends, with rules that do not care how we feel. First, locate the time window. Mark the anniversary of the prior major swing, then bracket it by a measured cycle 7, 30, 45, 60, or 90 sessions, depending on the market's dominant rhythm. Inside this window, do not trade. Observe. You are waiting for 3 precise signals to line up like gears. Signal 1 is structure. Record each leg on a simple swing chart. A trend does not change until a swing exceeds the previous reaction in price or time. That is the law of overbalance. When the counter move becomes larger than any prior correction, the engine has shifted torque. Signal 2 is the test. After the first sharp rejection from the MAC design window, expect a secondary test back toward the low or high. It should arrive on lower volume, narrower ranges, and hesitation at prior levels. Boredom is the tell. Exhaustion is the fuel. Signal 3 is the crossing. Price must reclaim an old level, often the last minor swing pivot or rotate through a Gann angle, advancing from 1x2 toward 1x1 in the new direction. Time and price are now in dialogue. Translate these into operations. Entry follows the secondary test only after the crossing prints. Risk is defined to 1 unit beneath the test. Size is mechanical, never emotional. Add only on fresh confirmations. A higher swing low, a close above the prior day's high within the same cycle window, or a clean bounce off the reclaimed angle. If any component breaks, volume surges on the test, the angle fails, or time overruns, the windows stand down. Certainty is an illusion. Confirmation is discipline. One condition remains: how to sit still once you are in. Patience manages the trade. Rules finish it. Mastery begins when the chart stops being a battlefield and becomes a clock. You arrange your day around windows, not whims. Mark the seasonal turn, the anniversary dates, the vibration clusters, and then do less. In those measured intervals, you watch for the market to cross old levels with authority, then hesitate, then breathe. The swing chart becomes your seismograph. An overbalance of time or price becomes your permission. If accumulation is true, a secondary test on lighter volume inside the time window will say so. If distribution rules, the rally will exhaust under prior highs. The enemy is not noise. The enemy is your need to resolve it. Patience converts boredom into data. Your method lives in 5 motions. First, define the zone. Time cycle plus price level creates the harmonic field. Second, demand confirmation. A break, a retest, a hold. Third, align the angle. Trend resuming along a steady one. X1 slope is healthier than a vertical lunge. Fourth, fix. Risk, where illusion dies. Beneath the secondary test for longs, above it for shorts. Fifth, accept the consequence. If the overbalance breaks against you, you are wrong by law, not emotion. These motions are mechanical. Your job is to keep them orderly. Discipline is the lubricant of this engine. You will feel urges to predict the reversal, to front-run the test, to double size on a story. Replace each urge with a rule. Wait for the window. Confirm the turn. Risk 1 to learn. This is not asceticism. It is alignment. When time dominates price, you relax. When price confirms time, you act. Your identity shifts from hunter to keeper of gates. Integration feels quiet. The chart hums at one pitch, and you join it. But one test still remains: how to carry the position through the inevitable disharmony without surrendering the law. Stand before the chart and breathe. The market rewards boredom. Confirmation beats prediction. Time dominates price. Volume can deceive. Let these be the quiet laws you carry into every session. We have moved from impulse to order, from guessing to measuring. Now the method resolves into a creed you can operate by without noise or haste. Begin with time. Mark the cycle, the season, the anniversary. Identify the window, then wait for confluence. If price reaches a prior level within that window, watch. Do not act. The first thrust is the crowd. The secondary test is the proof. require a swing chart turn that exceeds the prior overbalance, or refuse the trade. If accumulation precedes a crossing of old levels during the time window, accept the signal. If distribution shadows a rally that fails at angle, decline it. Treat volume as a witness, not a judge. Lower volume on the secondary test confirms absorption. Surging volume at a late move often confesses exhaustion. Operate by simple, definite rules. Enter only when at least two confirmations align with time. Place the initial stop beyond the last swing extreme or the failing window. If price does not confirm within the measured period, step aside. Time invalidates as surely as price. Add only on orderly secondary tests, never on emotion. Reduce when the market violates your angle, not your hope. Keep risk constant and small. Patience scales outcomes better than size. The psychological result is calm attention. You do not chase. You invite the market to prove itself. You accept boredom as the cost of precision. You measure, you wait, and you act only when the instrument vibrates in harmony with your rules. From here, deepen your craft. Refine cycle counts, tighten confirmation tests, and study risk as a living geometry across campaigns. Your edge is not prediction, it is the discipline to confirm.